accountant. I'm a business consultant. I am also a tax strategist, and I've been in the finance industry for over 18 years. As a solopreneur, right, or someone who's an entrepreneur. Hello, and welcome to another episode of the Tax Takeover. I'm your host, Mara Andrews, and if you are joining for the first time, I want to introduce myself to you. So again, I'm Samara Andrews, and I am the resident tax strategist or tax expert on the Tax Takeover, where every week we come before you talking about tax tips and strategies for entrepreneurs and individual taxpayers, right? So at the Tax Takeover, we have a motto, and that is that the wealthy don't start tax planning once they become wealthy, but rather use tax planning as a tool to grow their wealth, right? So that's what the Tax Takeover is all about. I'm super excited about tonight's episode because we briefly touched on what we were going to be talking about in more detail tonight last week. So hopefully you watched it, but if not, you can definitely go back and watch it in replay. But tonight we definitely want to spend a little more time on what I call pass-through entities, or what the Internal Revenue Service calls pass-through entities, right? So tonight we're going to be talking about the different types of businesses, right? Namely, S corps, LLCs, and partnerships. Okay, so let's jump right into it. Okay, so we're going to start with S corps. All right, so we talked about what an S corp was last week, but I am going to give a brief overview of what as well again. So one of the key advantages of an S corp, right, is the potential tax savings. This is why this one was being pushed so hard in social media streets, online. All the experts, accountants were telling you to open up an S corp, right? So if you open up an S corp, like I said, one of the key tax savings is that you can avoid paying yourself self-employment tax, right, on the share of profits, unlike a sole proprietorship or a partnership, right? So you can avoid self-employment taxes if you open up an S corp, right? So to take advantage of these tax savings, there are specific compliance requirements that you need to fulfill. So I need y'all to get out your pens and your papers because you're gonna want to take notes. And please make sure that you also if you have comments or questions, please make sure that you put them in the comment section below, right? And I'll be sure to address them throughout the show, right? So get ready, lean in. All right, so firstly, you must file a Form 2553 with the Internal Revenue Service within the first 75 days of forming your corporation during the previous tax year. All right. This form is what is required so that you can make the election to be treated as an S corp for tax purposes. All right. So I want to make sure that you understand that the S corp election is at a federal level, not at a state level. Okay. So that's why you have to file Form 2553 with the Internal Revenue Service in order to make this election. All right. Now, there are some qualifications, so let's get into it. So to qualify for S corp status, the corporation must meet the following requirements. Y'all take note. First, you got to be a domestic corporation, meaning that you have to be a corporation that is based within the United States, right? Or established within the United States. And then you have to have allowable shareholders. So there is further requirements that say that your shareholders also have to be U.S. citizens. And then there may be some loopholes around that. But for the most part, when they say allowable shareholders, that's what they're talking about. But definitely consult with a professional so that you can understand every single requirement, right? Another requirement is that you have to be an individual or a trust or an estate, okay? You cannot be a partnership. You cannot be a corporation, nor can you be a resident alien shareholders. Remember, I talked about allowable shareholders, U.S. citizens. Now you see why, right? You can't have any more than 100 shareholders at one time for the business, okay? And you can only have one class of stock, all right? And you cannot be an ineligible corporation, right? So there are certain financial institutes, insurance companies, and domestic international sales corporations that cannot take this S Corp election. So again, these requirements, there are a lot of them, right? So you want to make sure that you are seeking the help of a tax professional like myself to ensure that you are making this election properly and that you are eligible to make this election. All right. Now, S Corps must pay themselves, S Corp shareholders, I should say, must pay themselves a reasonable salary. All right. So a reasonable compensation must be paid to the shareholder employee in return for the services the employee provides to the corporation before a non-wage distribution is made to the shareholder employee. Okay, so this is where a lot of people get tripped up. So I want to make sure that you are paying close attention to this. If you are an S Corp, you should be paying your shareholders a reasonable salary for their compensation for whatever they're doing for the business. Any services they're providing, anything that they're doing for the business, they should be compensated for it. Okay. So make sure that you understand that, because I promise you, a lot of people get tripped up on this one, right? Now, again, this is above and beyond the distributions that are made. All right. Now, distributions can be made also to shareholders, and these are other payments by the S corporation to a corporate officer, and they can also be treated as wages as well, right? To the extent that the amounts are a reasonable compensation for the services rendered to the corporation. So again, has to be a reasonable salary, a reasonable wage. In addition to, you can have distributions, but you should be paying yourself or paying whoever your shareholders are a reasonable salary for the services that they are rendering or providing to the business. All right. Another thing that trips everybody up that people are not aware of: as corporations are required to hold yearly shareholder meetings with meeting minutes. Okay. And this is one thing that I know a lot of people are not doing, and a lot of accountants and so forth are not even telling their clients that these are the requirements. I know this because guess what? I have inherited clients, and I have had to walk them through and make them understand all of the requirements that they should have in place in order to maintain this S Corp election, right? So you are required to hold yearly shareholder meetings with meeting minutes. Now, here's the benefit of working with By Finance, right? We have quarterly meetings with our clients. And so when I meet with a client and they are an S Corp, I say, guess what? You can use one of our quarterly meetings as your required yearly shareholder meeting, right? In the quarterly meetings, guess what we do? We review financials. That is one of the requirements, right? We also usually record the meeting for the client, right? And it's transcribed. So guess what? Meeting minutes. And so they can also, there's a calendar invite that shows everybody that's invited, everybody that's in attendance. There you go, part of the meeting minutes again. So we take out a lot of the heavy lifting for a lot of these requirements for our clients. That's the benefit and the value that you get when you partner with Five Finance, right? Because again, I know a lot of people are missing the mark, especially in that requirement, right? So, and additionally, S Corps also must file an annual tax return using Form 1120S. Now, 1120S reports the business's income, deductions, and credits, right? But each shareholder will also receive a Schedule K1, which shows their income to be reported on their individual tax returns, okay? Now, these forms are kind of complex, so you might not want to go at this alone, all right? But I have a tax tip for you. If your S Corp can earn you passive income based on your material participation as well, or I should say your S Corp can earn you passive income based on your material participation in the business. You're probably saying like, Tamara, what is material participation? So the Internal Revenue Service says that if a person participates in the activity of the business for more than 100 hours during the tax year, and such participation is not less than the participation of any other person, then guess what? They are materially participating, meaning that they are going to be seen as this is earned income or ordinary income, I should say, okay? Not passive income because they are materially participating, right? So think of yourself as if you are someone who is going into the office, doing most of the work to keep the business running, then you are probably materially participating in your business, which means that you cannot claim the income as passive income, all right? Some other requirements is if you are participating for more than 500 hours, right? Or that the participation constitutes substantially all of the participation in the activity by all of the individuals. Meaning that if you a one person show and you doing all the work, y'all, it's not passive income at that time. You are working for that income. So it's considered ordinary income, okay? Because you're working for that income. So definitely know that one of the tax tips is that it could be passive income if you are not meeting those requirements of materially participating in the business, all right? So now let's move on to an LLC. So, a limited liability company or an LLC offers flexibility in the terms of tax treatment, right? So, with an LLC, you can choose how you want to be taxed. So, the default in of an LLC is to be treated as a disregarded entity. And I talked about this last week. But a disregarded entity just means that the Internal Revenue Service doesn't see you or your business separate. Y'all are seen as one and the same, all right? So if you're a single member LLC, right, you can be a disregarded entity. If you are a multi-member LLC, you can be a partnership. So you have flexibility of, being treated differently based on tax purposes. Now, for a single member LLC, one of the drawbacks or the cons is that you are assessed self-employment tax at a rate of 15%, right? So that means that the profits from the LLC will be taxed at that 15% rate for self-employment tax, okay? Again, this is based on your income for the business, right? Now, here's a tax tip. The self-employment tax does also help you qualify to collect Social Security once you reach the age of eligibility. So that's why some people do not mind paying it because they want to make sure that they are going to qualify for their Social Security. All right. Another tax tip is under the Tax Cuts and Jobs Act, business owners are eligible to deduct 20% of their qualified business income. This is what I call the QBI credit. I was astonished to learn that a lot of people did not know about this credit because I was just, giving this credit automatically. LLC, you're going to get QBI. It is what it is, right? So definitely make sure that you understand that there are still credits out there, even though you're assessed that 15% self-employment tax. There are still some tax tips for you to take advantage of some other credits that are afforded to LLCs, all right? Now, however, LLCs can also elect to be treated as an S corporation or a C corporation, providing the potential tax saving opportunities. So, if an LLC chooses to be taxed as an S corp, right, the same tax advantages that an S corp has is what they will enjoy as well. But again, you have to file proper paperwork in order to be seen as an S corp. Because remember, the S corp election is at the federal level. Okay. Now, in terms of compliance for LLCs, generally they have fewer formalities than corporations. All right. Single member LLCs typically report their income and their expenses on a Schedule C form of their 1040. So if you're a multi-member LLC, then you're probably reporting on a 1065. But the Schedule C form is what LLCs are using, right? So finally, let's talk about partnerships, right? So a partnership is, they offer the advantage of a pass-through taxation where income and losses are passed through to the partners on the individual tax returns. Okay. Now, a partnership is made up of two or more partners, and the partnership must file an information return using Form 1065, which reports the partnership's income, deductions, and credits. Okay. Now, each partner will receive a Schedule K1. Now, this indicates their share of the partnership's income or loss. Okay. So the tax implications are passed on to the partners, right? Another con is that they are responsible for the debt. We talked about that last week, right? So partnerships are responsible for that debt. But the tax implications are that the partnership doesn't pay any taxes, they're passed on through the partner. So all the income reported to the partners from the partnership is generally, this is a good one, taxed at a capital gains tax rate, right? Which ranges from anywhere from 0 to 20% of the reported income, right? So that is a good one. Generally, it is taxed at a capital gains tax rate, which is a lot lower in some circumstances than your ordinary or earned income tax rates, right? Now, here's the tax tip. Lean in for all of my couples who have a partnership, right? If your spouse carries on the business with you, right, and you share in the profits and the losses, right, you may be considered partners, right, whether or not you have a formal partnership agreement. But if so, if you have a formal partnership agreement, then you should report the income or the loss on a 1065 form, right? But if you don't have a formal agreement, you should report the income or loss on a Schedule C, and you can do that, right? But it has to be in the name of one spouse as a sole proprietor, right? So if the spouses can elect not to treat their joint venture as a partnership by making a qualified joint venture election. That's the tax tip, okay? So if you are married and y'all are in business together, you can use the qualified joint venture election to treat your partnership, right, as an Schedule C or sole prop, right? So again, you can't have it legally registered with your state as a partnership in order to take advantage of this tax tip. Okay, I want to make sure that I say that so that y'all understand clearly what I'm saying, okay? So again, a qualified